The social objective of skilled investment should be to defeat the dark forces of time and ignorance which envelop our future. John Maynard Keynes. Once we realize that imperfect understanding is the human condition, there is no shame in being wrong, only in failing to correct our mistakes. George Soros. The things you own end up owning you. Tyler Durden. Preface. The original version of this book came out in spring 2006, near the tail end of what has been called the Great Moderation, a period of low volatility, low interest rates, flat yield curves, and strong global equity and property markets that made investors relatively complacent about risk. Since then, we have seen a dramatic unwinding of this paradigm as extreme volatility has been ushered back into the markets. Large and divergent interest rate movements have become common, and equity and housing markets have in many instances fallen sharply from elevated levels. Central banks and governments around the world have responded with creative liquidity measures and bailouts, as well as monetary and fiscal stimuli. These actions have not come without costs. Commodity prices exploded and then sold off, further complicating the inflation outlook for policymakers. Stability seems to have bred instability, as Hyman Minsky once observed. Leverage, built up during the low volatility quiet period, finally unraveled under its own weight, helped by central banks that raised interest rates. Although many were left naked as the tide receded, particularly exposed is the web of complex derivatives, SIVs, CDOs, CLOs, and so forth, and the financial creativity in the home lending arena which created so much credit around the world. It is now clear that home prices do not always go up, much to the chagrin of rating agencies, governments, banks, investors, and leveraged homeowners globally. For more on this, listen to new Appendix A, The Crash of '08 by Dr. Lee R. Thomas III. Once the easy money dried up, a lot of the manager predictions in this book came to fruition. In particular, we have seen the US dollar fall, commodities and oil rally to levels not seen since the 1970s, the housing boom turn into a bust, major equity markets around the world crash, credit spreads blow out, and volatility return from historically low levels. Arguably, excess credit was the main driver of the low volatility period from 2003 to 2007, whereas the tightening of credit has led to many sharp reversals in 2007 and 2008. As central banks again cut rates to bail out investors, the next leg of this cycle is upon us. But will this process lead to inflation, hyperinflation, stagflation, or is deflation unavoidable? Likewise, will the world turn Keynesian with continued government stimulus, or take the pain the Austrian way? The adage that there is always a bull market somewhere might very well speak to an imminent increase in government intervention, regulation, and legal bills. Will the trend toward globalization be altered in the process, and what will the investment implications be as a result? Other important questions face investors. Will the emerging world decouple from the developed world? Can China, India, Brazil, Russia, and others continue their dramatic growth without the help of their biggest customers? Is the United States in for a Japan-style lost decade, a European-style muddle-through, or another Great Depression? It became clear in 2008 that macro variables have emerged as the predominant drivers of investment performance. Bottom-up, micro-focused equity, bond and commodity investors have been decimated, while global macro managers, for the most part, have been able to preserve investor capital. As such, global macro portfolio managers are exceptionally well positioned to navigate what could be a sustained period of choppy, volatile